Well, howdy there, folks. Welcome into today's video. It's a four-piece here today. I want to quickly react to just this little 1-minute clip here at the end of Dan Ives speaking about Tesla being a golden buying opportunity. I want to speak about that. I thought that was an important subject. Then we're going to get into this one from yesterday. This is a long-term bull market, says Ed Yardini. I'm looking forward to kind of sharing my opinions and perspectives on that one. Then we're getting into this one here. We're seeing levels of speculation or speculative options trading like never before. Okay, that's going to be an intriguing one to get into, and we'll speak about, what does that mean for the market? Volatility, does that mean we're about to have a massive spike in volatility? Those sorts of things. And then I want to get into this one. There's a big opportunity to see a broadening in this market rally. You're going to hear what this gentleman from JP Morgan had to say from the private bank side 6 hours ago. The private bank sides, think of it as super high net worth for JP Morgan. So when you ever hear a gentleman like this talk, like this is the advice he's basically giving to the high net worth individuals of JP Morgan, because JP Morgan has their regular side and then they have their private bank side, which is a whole different kind of division there. Okay. All right, guys, appreciate you joining me. Thanks so much for being here. All I ask in return, smash that like button and make sure you're subscribed here to the channel. I think we're well over 42,000 subscribers now on the channel. Got a free new workshop for you guys. How much money you need to retire? Pin comment down there for access to that. It's absolutely free. If you're ever focused on, how much does it take and those sorts of things, that video gets all into that, how much it takes to focus full time on investing, all those sorts of subjects. Okay. All right. So let's get into this.
I wanted to actually come back to Tesla and just have you respond to this Wells Fargo note today, questioning obviously significant discounts, profit per car coming way down, and their price target at Wells now, I think 125.
Yeah, we strongly disagree with him. Obviously, we respect the analysts and the call, but I think right now overly negatively discounted in terms of the Tesla story. Look, near term, clearly units going to be soft for 1Q. Just getting back from the region, I believe price cuts are now starting to subside in China. That's important. I think when you look through the next 6-9 months, we're going to look at this as more of a golden buying opportunity for Tesla over the next 2-3 years, especially with AI, rather than time to throw in the white towel. But for now, we all know, the New York City cab driver is bearish on Tesla here.
What does that mean? Sorry.
I love that one.
Everyone's bearish. The piling on's there. The bears are coming out of hibernation mode. I get it.
I see what you mean, yeah.
But we believe now is not time throwing the towel on Tesla and Apple. I think we see here 6-9 months now, stock's much higher.
Okay, do I view right now as a golden buying opportunity for Tesla? The answer to that is yes. It's one of 3 golden buying opportunities we've really had in the past 5 or 6 years, essentially. Okay, the first golden buying opportunity was when I was buying Tesla stock. This was back in late 2018 into the first half of 2019. That was a golden buying opportunity for Tesla stock. The second golden buying opportunity was actually at the very beginning of 2023 when the stock dropped to about $101 at the lows there. That was a second golden buying opportunity in the past 5-6 years. And I view this time period we're in right now as a, let's call it the third golden buying opportunity for Tesla. And I don't want to go super in depth on Tesla. I've obviously done that in the main channel very recently and spoke very in depth on kind of my views for Tesla for the remainder of this year plus the next few years. So if you didn't get to see that, check out the main channel, Financial Education. That, I got a video on that just goes in super in depth in regards to Tesla. Okay. All right, let's get into Ed Yardini and his views on the market, and I'll share my perspectives and opinions on that.
It changed a bit, right? Nvidia cooled down and some of these other areas pick up. What are you thinking?
I'm thinking this is a healthy development, quite honestly. We've seen a lot of focus on the outperformance of the Magnificent Seven. And as we know, some of the Magnificent Seven haven't been so magnificent recently. And if some money comes out of the Magnificent Seven and spread more evenly across the rest of the market, that would be a healthy thing. For example, the S&P equal weighted index has recently gone to a new high, which is a good thing. So I think that a broadening of the market is probably what's in store. And I think we're also likely to see less momentum. I just looked at the latest Investors Intelligence bull-bear ratio, and it's off the charts. It's not completely off the charts, but it's up to 4.2. It can go higher. It has gone higher in the past, but this is up from 0.56.
Hey, real quick, I got tennis elbow. Anybody ever had that before? If you ever had that and you got some advice to give me, let me know in the comments section. Oh man, sucks. I haven't been able to do pull-ups in probably a month and a half, and I've tried letting it heal, and it's just not working. So if anybody's experienced that before, let me know in the comments if you got any advice for me.
At the bottom of the of the bull market, right when the bull market just started, the sentiment was horrible. Now everybody's bullish, and that means there may not be enough bears around to convert into bulls to keep the momentum going. So I think we're going to see some weakness in the momentum trade and more of a spreading of the market to other sectors and industries.
It's interesting.
So what he just brought up there is a very important point. That's a great point by Ed Rondini, and I think it's important everybody understands that so they understand the mechanics of the market. What he just said was so many people are bullish now, it's harder to find people to bring them over to the bullish side, right? Which is 100% accurate. If we go back to, let's say, at this time last year even, right? So many people still bearish on the market, still kind of in that 2022 mentality of market dropping, in that viewpoint of the recession. And so as time ticked on, we were able to just kind of pull more and more people over to the bullish side. Now there's not nearly as much of that. Now there is still ridiculous sums of money on the sideline. I believe money market funds, 6 trillion plus or some insane number right now. I think it's pretty much a record all-time high, right? And so there's still money to come over, there's still bears to bring over, and then there's still the bulls like myself that buy every single week, right? I bought stocks here today. You want to see the moves I made here today? I bought 3 stocks. Check out my Patreon. You can support my content and see it on there. That's in the description area, right? I bought stocks today. I bought stocks in the public account today. I buy every single week. So there's always bulls like myself that are buying every single week, right? Imagine people getting paid, always funneling in money to the S&P 500 index funds and those sorts of things. So there's always money to come in. That's important to understand. But in terms of that, a massive amount of bears, bringing them over to the bullish side, we went through a lot of that now at this point in time. And a lot of the bears that are left are more the people that are almost always bearish. You know, there are a lot of the people that are, you know, they always look at the glasses half empty. Let's just put it that way.
And I was going to ask you whether you feel like you still have to prove to people that this is, in fact, a bull market that's not close to being finished yet.
Well, I think we're way past the point where I have to prove that this is a bull market. I think we all know it's a bull market, but look, bull markets can last a long time until we get hit by another recession, and that requires the Fed to be raising interest rates. I didn't anticipate a recession over the past couple of years. We just went through an environment where we had the most widely anticipated recession of all time, so it turned out to be a complete cadeau, complete no-show. And I don't see a recession this year or next year. I mean, the Fed has already raised interest rates. I think inflation has come down. I think it's going to stay down. You know, excluding shelter, the CPI inflation rate is already at 2%. You know, when you have kids and you go for a drive and they say, are we there yet? Well, we're there, except for shelter, and shelter's coming down. Shelter inflation's coming down. So I think it's a long-term bull market. I got still 5,400 by year end. That was a pretty bold call up like a year ago, but
it was.
Right now it's looking pretty conservative.
Yeah.
And why not more? I mean, people ask me, why aren't you raising your numbers? I say, well, you know, there are kind of limitations in terms of what earnings can do and how much higher valuation can go. But I see 6,000 next year on the S&P 500 and 6,500 after that.
And do you
6,500
dismiss the inversion of the yield curve because the Fed's going to be cutting rates and thus you'll have a re-steepening?
Before we get into the inversion of the yield curve, those sorts of subjects, okay, what Ed Yardini said about a minute and a half ago was very important. And he basically said he was bringing out a point around the market will eventually, you know, have a bear market, and he was talking about next recession. Well, there's 2 ways you can get a big bear market again, and we will get another big bear market, but the timing of that, it could be a little bit away still at this point in time. You get another big bear market, a lasting bear market, not like, oh, S&P fell 5-10%. I'm talking real bear market, 20% plus, down for a long time, right? Unemployment cycle, or what? Fed hike cycle. So if we go into another Fed hike cycle, okay, then we can talk about another big bear market coming, right? But that's a big question. Is the Fed going to take rates from 5.5 to 7, 8, 9, 10? I mean, it's a possibility, but I think that's a fairly low probability. I think there's a higher probability they just keep us at in the 5s for a bit here, right? Unemployment cycle, we're going to see that at some point in time, but it's not showing up yet. And so we still need, if you're talking about an unemployment cycle, you still need the amount of job openings to collapse a lot more than it has. Once you get there, then you can start worrying much more about an unemployment cycle.
How do you view that?
I wrote a short little study that's on Amazon. I'm not promoting it because I'm going to make any money on it, but because in 2019, Melissa Tagg and I, my colleague, we wrote a piece on the yield curve and what does it really mean. And this notion that an inverted yield curve means that we're going to have a recession, I think misses an important point. And what it really does is it predicts a process. It predicts the process that if the Fed continues to raise interest rates, something will break in the system, and that will lead to a credit crunch. And it's credit crunches that cause recessions. Well, the yield curve got it absolutely right again. And we did have a financial crisis last year, but the Fed came in and played whack-a-mole. That liquidity crisis, they whacked it right down with the liquidity facility, and we didn't get a credit crunch, so we didn't get a recession. So as long as we don't get a credit crunch and not a recession, I think the bull market continues.
I mean, you've never had a recession without an inverted yield curve, but an inverted yield curve alone doesn't mean you're always going to have a recession. I think that's the fair way to say it, but it's been inverted for so long that people are still
a recession. So as long as we don't get a credit crunch and not a recession, I think the bull market continues.
I mean, you've never had a recession without an inverted yield curve, but an inverted yield curve...
You've never had a recession without an inverted yield curve.
Doesn't mean you're always going to have a recession.
But an inverted yield curve doesn't always mean you're going to have a recession.
I think that's the fair way to say it, but it's been inverted for so long that, people are still at the stage of, well, I got to keep my eye on that because the yield curve has always meant something, and the bond market has been right many times, as you obviously know.
Yeah, well, I've been fighting the inverted yield curve story. I've been fighting the leading indicator story. I think the leading indicators really are an indicator of what's going on in the goods economy, much more so than in the services. And the inverted yield curve, again, I think it got it right in terms of calling a financial crisis. But the Fed this time around did something different, which it hadn't really done before, and that is it came in with liquidity to keep the financial crisis from turning into a credit crunch. I really should correct myself. I mean, the Fed got a lot of experience dealing with these credit crunches and avoiding them back in 2008, 2009, and again in the pandemic. So they're pretty good now at playing whack-a-mole with liquidity crises.
That's true. Whoa, is it really that complicated? Let's think about it. What do you do? Okay, you got a liquidity problem. You got a credit crunch. What do? Rates down to zero. Back everything. To be honest, it's not the hardest problem to solve. Take rates down to zero, back everything, come out, tell the market you're gonna, have everybody's back, and boom. Same thing they did obviously in 2020. Next one up here, we're seeing levels of speculative options trading like never before.
Kick off its AI conference on Monday. Ahead of that, our next guest says that she is seeing levels of speculative options trading tied to semiconductor and technology stocks hitting levels never seen before, and many are positioning for that momentum to continue. She documents this in her latest piece titled Frenzy Over AI and Nvidia Turbocharges the Options Market. Gunjan Banerjee is the lead writer for the Wall Street Journal's live markets coverage, as well as a CNBC contributor. And Gunjan, this is casino-like activity. What's taking place here?
That's right, Becky. One trader said to me, this is the biggest casino in the world right now, referring to Nvidia options, referring to semiconductor options. And activity has really hit the highest levels ever. And over the next few days, we have an action-packed week for the semis trade, right? We have this Nvidia conference, we have Micron earnings, SMCI, Supermicro set to join the S&P 500 after the market closed today. It's funny, this conference that Nvidia is holding keeps coming up in conversations with traders almost more than, the Federal Reserve's interest rate decision. This is the thing that everyone keeps bringing up. And I think people are really on the edge of their seats to see how much higher can this AI trade go? How much room is there to run here?
If you're looking at Nvidia shares just over the last 6 months, they've doubled, but this week they're down 7.5%. So I think people are starting to question, is this a straight up and to the right trade?
That's the biggest question out there on Wall Street, because let's not...
Is it a straight up? Yeah.
Yeah,
Yes,
the
it
path
is.
of Nvidia has wide implications for the path of the broader market. I was looking at some data, and the S&P 500 and Nvidia have moved in tandem in, say, 14 out of 19 of the past sessions. What's really interesting is when you look under the hood, people have been positioning for the stock to keep going higher. What traders are telling me is that the prices of trades that would profit if Nvidia kept soaring, think $1,000, calls pegged to Nvidia shares, are way surpassing the types of bearish trades that would profit if the stock fell. So there is just, when you look at the stock, it's not telling the full story. There's even more exuberance and more speculative activity under the surface.
Now, here's why Nvidia stock is likely going to continue to go a lot higher. Do I have any short-term call options on Nvidia? Heck no. But let me explain to you exactly why Nvidia stock is likely going to continue to go higher throughout this year, and every single dip in the stock will continue to get bought up. It'll dip for a week or two, boom, it'll be bought right up. Next thing you know, new all-time high, new all-time high. Here's why, okay? One, remember earlier we spoke about if you can grab a lot of people that are bearish and bring them over to the bullish side, it's a game changer, right? The same thing for individual stocks. There's so many people that have been doubting this Nvidia rally the whole way and are still doing it now. Even though that forward P is not high, they're still doubting it. They've been doubting it the whole way. They've been bearish on the stock the whole way. There's still such a ridiculous amount of people to pull over to the bullish side that will finally eventually throw in the towel and say, damn it, I got to freaking buy this stock. What am I doing? I got to get in, right? That will eventually pile into this, and we know Wall Street focuses very on short term, right? They're not, many times they're not thinking about the next 6 to 12 years, they're thinking about the next 6 to 12 months. And so if you are a Wall Streeter and you're thinking about the next 6 to 12 months, eventually at some point in time, you're going to have to come over to the Nvidia side and realize, oh my gosh, there's money to be made here in the short term if you're of that mindset, right? That stock will continue, every dip will continue to get bought up in that stock until the numbers break. Until the numbers break down and they report some sort of guide that's weaker on a year-over-year basis or even a sequential basis, until that happens, that stock will continue to go higher and higher and higher and higher. Okay, and the big event next week, I'm sure they're going to have a bunch of partnerships, a bunch of new chips, a bunch of software talk, and how they're going to monetize there. And that's going to be a whole host of excitement. And that will be analysts will be upgrading next week, likely, and the week after, and talking about how this is going to be so bullish. It's going to bring more people over to the bullish side. So that one will continue. Every dip will continue to be bought in Nvidia until the story breaks. And when the story, I mean revenue. When the revenue starts going down on a sequential basis, or there's a hint of it going down, that's when the story will break. That's when that stock will start to break down, and then we'll see where things happen from there, because then you could get maybe a 50% drawdown or something like that in that stock in a matter of a 6 to 12 month span. But good luck predicting when Nvidia's revenues are going to start going down on a sequential basis. You might be waiting still another year for that, maybe a year and a half, maybe 2 years. It might be a bit of time here. The chances this next quarter, I wouldn't be so confident in that.
Fed may not be front and center for a lot of these traders, but maybe it should be if you're getting to the point where they're questioning the very rationale or the thesis that the Fed's going to cut rates sooner rather than later. These hotter than expected inflation numbers have done a number on things like crypto prices, and you could see that kind of playing out in these tech stocks too.
That's right. I mean, that's been the fascinating disconnect, right? Is it feels like everyone has moved over to the soft landing trade, this idea that inflation is going to fall. And not much can shake that, at least in the stock market so far. I think a lot of the fear this week has been concentrated in the bond market. We saw a little bit of a sell-off in treasuries. But take a look at the action yesterday. Microsoft hit yet another high in part because of an AI announcement. We had, a 0.3% sell-off in the S&P 500. So right now, that fear about decreased rate cuts is simply not seeping into the AI trade, the Nvidia trade, and the S&P 500.
It's just that when you see stocks and bonds differentiate, people always start to wonder who's right. Can that bifurcation continue? And, traditionally, conventional wisdom has always suggested that the Treasury market's smarter.
Right. The bond market's always a smart money. Yeah. Right. Who's the smart money right now? Is it the Nvidia speculators or is it the Treasury traders? I think that's one of the biggest questions.
That's just not fair. That's just not fair. And guess what? I got more news for you in regards to Nvidia. When we're talking about a lot of people playing options on Nvidia. Why is that happening? It is not just, you play a little chess with me for a moment, okay? This is not just like, oh, people think it's going higher, so they're going to play options. You know what else it is? It's also people that are betting against the stock that need to offset that somehow, so they'll buy way out of the money calls on the stock, right? And it's also very important, people that essentially are scared to really put big money into the stock, but they do believe it's going higher, so they're like, you know what, I'm going to play some options here, which is actually kind of a very cautious outlook, right? Think about it. You're a fund manager, and you have two options here. You can put $25 million in Nvidia stock, buy the stock straight up, or you can buy $1 million worth of call options. You think the stock's going higher over the next 6 to 12 months. Well, a fund manager might look at that and they say, you know what, I don't want to risk the 25 mil, but I will risk $1 million on these options, and hopefully, the stock goes on a run and I make 3-5 mil. If I don't and I lose it all, it is what it is, right? It's more of a cautious outlook. So that's other factors you've got to consider when it comes to a stock like Nvidia. So, I hate, the fact that they just keep talking about it the same way and trying to bring it down and like, oh, it's speculation and all these sorts of things. I'm like, who's right? The Nvidia speculators? Look at the freaking numbers, man. It's not speculation. Like looking at the financials and tell me what you see.
Right now, but I think we have seen this divergence between stocks and bonds kind of happen for much of this year, right? Stocks have kept rising. The AI trade has kept reaching new heights, even though we've seen a little bit of a sell-off in the treasury market. And I think next week with this Nvidia conference is the next big test of that.
What do they need to hear? What do traders say they need to hear from Nvidia on Monday in order to make all these trades make sense?
So this has become a story stock. I think a lot of people are watching Jensen Huang's speech on Monday. He has a keynote address. What does he say about new products? What does he say about customer demand, the total addressable market? I think that's really going to be the highlight for a lot of people because right now they're clinging to his every word.
We've seen speculative frenzies in the past, and I think everybody's still trying to figure out where we are in this cycle. Just because it feels like there's been a frenzy doesn't mean that it's going to be over anytime soon. But what kind of signals do traders watch for to think, okay, this is when it's getting a little too hot?
So what I will say is we are seeing levels of speculation in options, at least, that we have never seen before.
What does that mean? What does that tell you?
So it tells you that people are really, really excited about this AI trade in particular because most of it is concentrated in semiconductor stocks. And I think some people are looking to play catch up. Maybe they missed out on buying Nvidia shares. So now they're turning to some of the most speculative bets, the riskiest trades to profit from a continued rise in the stock. And by one measure, options activity is actually surpassing stocks activity for the first time in 2021. And remember what was going on in 2021 in terms of that speculative frenzy.
It's a hot trade, but you hope you don't get burned by it.
Exactly.
Yeah, and I think the options play is risky. I think it's risky. And the reason I think it's risky is in order to make any good money, you got to go way out of the money. You got to go way out of the money. You got to pay huge premiums because there's so many people interested, right? There's so many funds interested in these options. So you got to go way out of the money, and you're setting yourself up for a situation where Nvidia could easily chill for 1 to 3 weeks, right? Or downtrend for 1 to 3 weeks. Eventually, that stock's going to get bought up and then reach a new all-time high. But the problem is, if you're going way out of the money, you need that stock to roll fast, quickly. Even if you're buying, let's say, I bet you if you're buying Nvidia calls, $1,000 strikes, I bet you've got to pay a big premium for that, even if it expires in like 2 weeks. You know what? Let me pull it up right now. I want to pull it up for you guys, and we're going to look and see what the premiums are looking like there. Oh my goodness, guys. Check this out. You would be flipping my flapjacks. So what I pulled up here, these ones expire essentially in 2 weeks from today. 2 weeks from today, these expire. For $1,000 strike, you got to pay about $16 for that. So you need the stock to go to $1,016 just to break even 2 weeks from now. And keep in mind, Nvidia right now is what? $880. $880. Woo-wee! You need that baby to roll big. Roll tide, baby. Oh my gosh. I mean, that's what I'm talking about. Let's look at next week, for instance. 1 week from today. So March 22nd, 2024. What do you have to pay for a $1,000 strike here? Let's see this. You would have paid, oh my gosh, nearly $9 for a $1,000 strike? And this expires next week. So this is what I'm talking about in terms of like, options being dangerous right now, because the premiums you've got to pay are substantial for this. I mean, even 900s, which, let's see what you got to pay for a 900. You got to pay $34 for a 900. $34 for a 900. It's a big premium, right? So, yeah. Anyways, next one up here. There's a big opportunity to see a broadening in this market rally. JP Morgan.
Kennedy, he is chief investment strategist at JP Morgan Private Bank. And Tom, the hot PPI and CPI numbers that we got for this most recent month have a lot of people questioning whether we really are going to see a soft landing, whether the Fed's going to be able to cut rates. You're still a true believer.
Yeah, we certainly are. It certainly challenges a soft landing, without a doubt. But when you look at underneath the surface of the inflation data, what are you seeing? Is goods-based inflation was deflationary for a period of time, bottoming out. So we're through that phase. The COVID-induced inflation rebound, if you will, it's hard to say that with inflation coming down, that seems to be behind us. But as we start to look forward, it's all about the labor market. And inside the labor market, we've just gone through a generational surge in labor supply. And that's from a domestic sense and from an international sense. Domestically, work from home behavior seems to be here to stay. A LinkedIn survey from last year, which was the first real test I've seen in a normal time. 2023, what about you guys? I wasn't wearing masks, was going out, everything was fine. 50% of all jobs filled on LinkedIn were either hybrid or full work from home. That's here to stay, so it draws people back into the labor force.
When you start looking at what happens next with the markets, you're looking for a change in leadership. You do think the mid-caps are going to step up and take over the reins?
I think there's a really big opportunity to see a broadening in this rally. The concentration in performance in U.S. tech has been stark. We all talk about it. But really, since October, when that Fed pivot came into fruition, S&P tech sector has led, and at the same time, Russell 2000 and mid-caps have outperformed. It's quite odd, given that the tech concentration is so low. I think it can broaden out for a few reasons. Earnings should move from, in the mid-caps, from negative last year to plus 10 this year. Valuations are relatively cheap. And there's a heavy concentration in industrials, which is where the U.S. government is spending. And even if we get a change in leadership at the president level, it looks like that spending should be durable.
Okay, what if the inflation picture really doesn't tame down anymore? I realize it's only 2 months that you've seen CPI and PPI higher, but if you're not going to get back to 2%, that means the Fed's not going to be able to cut rates. And it seems like a lot of what we've seen, the frenzy in the market, has that as a predication.
Yeah, I agree with your point. I think this is one of the biggest risks the market is dealing with. That's why we spend so much time talking about it. The path towards the disinflation, I think, is that labor surge. The Fed, I don't think, needs to wait for 2%. Just confidence that they can get there.
Well, confidence that it's not going to go above 3%. And at JP Morgan, Jamie Dimon has been the one saying, I don't think they should cut rates yet, that there's more concerning things coming potentially. Yeah,
Jamie is a steward of the Fortress balance sheet. He's always worried about what the risks are. We're in the room trying to help him figure those out. My job is to help clients navigate what the most likely scenarios are. The immigration surge is one we haven't talked about yet. A generational shift as well. 1%.
Okay, before we go further here, okay, let me give everybody a little history lesson. A little history lesson from something that happened shortly after I got in the market. Remember, I got in the market end of 08 into 2009, right? And then started, investing more and more as the years ticked on, right? Well, very shortly after I got in the market, probably about maybe, this was probably, I think, late 2010, maybe early 2011, from what I remember. There was something that started happening, which was called double dip recession. And a lot of people started getting very concerned, and you got sell-offs in the market because people were concerned about double dip recession. And for CNBC for like 2 months, oh my gosh, the amount of times I heard double dip recession was ridiculous. Now, how does this play into what's going to transpire now? Well, now what you're going to start hearing is basically something along the lines of double dip inflation. But instead of double dip inflation, maybe they'll call it 2 scoops of inflation. Something like that, okay? Basically meaning the worries around inflation spiking for a second time, right? Now, it might be accurate. Maybe there's true fear there, right? Or maybe it's just a bunch of baloney, kind of like the double dip recession fear was just a bunch of baloney. And the reason the double dip recession fear really got rolling was you got some weak economic data for a particular time, and so people thought, oh my gosh, we're going to go into another recession, right? And so this is where the inflation numbers come in. You get a couple bad months in a row of bad inflation numbers, and suddenly people start worrying about another wave of big high inflation coming, right? Which might come or just might not. But it's just about the fear of it. And the fear causes sell-offs in the stocks. It causes sell-offs in the market. And especially to those that are more, let's call it higher valuation names many times, or just stocks that need to take out a lot of debt, those sorts of situations.
The U.S. population last year was from immigration. We haven't seen population growth like that since 1910. Now, to bring the election in here, right, that stalled because we had a literacy test that slowed immigration. That's a risk here, too. But to really think the labor market is going to
slowing immigration is a risk?
Yeah. Inside the election, this is one thing that really separates President Trump from President Biden in the way that they've handled immigration.
But you're saying that open borders are a good thing, or?
For the U.S. economy, they're fantastic. From the Fed's perspective, to tame inflation, immigration is a fantastic thing for them. You're getting the calming in the labor market just from the supply side rather than having to lay folks off. It's a fantastic opportunity set for them.
Wouldn't you like
that? That's why I like the folks from the private bank, man. They think differently over there. They're playing a little chess.
Legal immigration instead?
They know what's
Most
really
of the
going on in the
immigration
world.
has been legal. I mean, this is always hard to see in the data exactly, but the Biden administration has ramped up visa and immigration from a legal sense, and of course there's been illegal immigration as well. But this is one of those places, as we look to the year ahead, where economics and politics really intersect. And for investors, I think we generally look around in history and say, the elections don't matter. But this might be one instance where it does matter because we've been very lucky to have immigration that has cooled this labor market the way it has.
And you think that's just misunderstood by the American public?
No, I just think it has political factions to it that are beyond just pure economics.
In all due respect, most folks in the American public don't have a flip and flapjack and clue what this man's talking about right now, okay? Come on. Let's just be honest about this.
In any Gallup poll we look at, it's the biggest issue for Americans is immigration. And so it's polarizing. But if you just look at a simple economy, if you see strong demand for jobs, you can cool that in two ways. Bring more people to the workforce, or you have to cool that demand.
But there's the second order effect, which I think is what Becky's referring to, which is the legal immigration, which has been ramped up.
Yes.
Plus the illegal immigration.
Absolutely.
You could argue the illegal immigration, by the way, is also good for the Fed. I mean, I know that sounds completely perverse, but it's the case.
Yeah, I don't think it's perverse. I'm agreeing with you wholeheartedly. You need a balanced labor market to be confident that inflation won't surge back to 3%. And the labor supply has helped quite a bit.
Let's pivot quickly just to talk about the lending situation right now. You were making the point that private lending has been pretty good. If yields continue to climb, what will that mean?
You're starting to see a reopening in financial markets. And from the Fed, when they meet next week, the realist there, the person who's saying, I'm not so sure inflation will go back to 2%, they will look at the IPO market ramping up or opening again, and lending practices go up. Yeah, if rates stay higher for longer, we should continue to see lending activity be subdued and not ramp higher. But I think the market is giving private credit, the private direct lending, the market I'm worried about that. That's a bubble. But when I look at what a bubble is, Becky, it's debt growing in excess of profits, right? As a simple definition. And in the aggregate finance market, you're seeing profits up, lending activity track it as well. Just private credit is taking market share from high yield and loans so far.
All right, appreciate that gentleman's thoughts there. Once again, you want my new free workshop, how much money you need to retire, there's going to be a pinned comment down there. Much love as always, and have a great day.